Ladies and gentlemen, what I'm about to tell you is not a minor adjustment. It's a complete reversal of my Q2 outlook for silver and silver miners. And the reason is simple. The market is no longer being driven by industrial demand alone. We are now entering a phase where monetary stress, sovereign debt pressure, and central bank behavior are pricing precious metals in real time. Silver is no longer just a commodity. It is becoming a monetary signal. And silver miners, they are the leverage expression of that signal. What is unfolding in silver is not a commodity cycle, it is a structural repricing silver represents in the global financial system. For decades, silver was traded as an industrial metal with occasional monetary overtones, useful for electronics, solar panels, and photography. That framing is now breaking down. The deeper reality is that silver is beginning to behave less like an input in manufacturing and more like a hybrid monetary asset, one that responds primarily to stress in the global currency system rather than fluctuations in end-user demand. When monetary systems are stable, commodities dominate the narrative. Copper tracks construction, oil tracks growth, and silver quietly follows industrial production with occasional spikes tied to investment flows. But when monetary confidence erodes, the hierarchy changes. Investors stop asking how many solar panels will be built next quarter and start asking what holds value when paper claims are expanding faster than real wealth. That is when silver's second identity emerges. It's always had this dual nature, but for long periods, the monetary side is suppressed. In moments of systemic strain, it reasserts itself. The key driver behind the shift is not sentiment in isolation, but the gradual deterioration of trust in fiat currency stability. Central bank balance sheets have expanded dramatically over the past decade, and the marginal response to the stress has consistently been more liquidity. Each cycle leaves behind a larger monetary base and a higher threshold for confidence. Over time, this changes industry behavior. Assets that are not dependent on counterparty promises begin to attract disproportionate attention. Silver, alongside gold, sits in this category, but with a more volatile and explosive profile due to its smaller market size. What makes silver particularly sensitive is its dual demand structure. Unlike gold, which is overwhelmingly monetary investment driven, silver is split between industrial consumption and financial demand. This creates a unique tension. When industrial demand remains steady or grows modestly, but monetary demand accelerates due to macroeconomic uncertainty, the price does not adjust linearly. It compresses and reprices abruptly. The market often misinterprets the early phase of the shift because industrial indicators do not yet show distress. By the time they do, the monetary repricing is already underway. Another critical layer is real interest rates. Silver does not respond well to nominal rates alone, it responds to the real return environment. When inflation expectations remain sticky while policy rates struggle to keep pace, real yields decline even in restrictive policy regimes. This environment reduces the opportunity cost of holding non-yielding assets. Historically, these are the conditions under which silver begins to detach from its industrial anchor and trade more like a monetary hedge. The transition is gradual at first and sudden once positioning adjusts. At the same time, the supply side of silver introduces a constraint that is often underestimated. A significant portion of silver production is not driven by silver-specific mining, but by byproduct extraction from base metal operations. This means supply does not respond efficiently to rising prices. Even when demand shifts sharply higher, production cannot be scaled in a straightforward way. This lag creates structural tightness that becomes visible only when inventories begin to decline. By then, price discovery is already accelerated. The market also tends to misprice silver because it anchors too heavily on historical industrial ratios with gold and copper. These ratios are useful in stable regimes, but break down when monetary dynamics dominate. In such a phases, silver behaves less like a pure of industrial metals and more like a leveraged monetary instrument. Its volatility is not a flaw, but a reflection of its position at the intersection of two conflicting demand systems. What is increasingly evident is silver is no longer being evaluated purely on consumption metrics. It's being reevaluated as a store of value in environments where paper assets are simultaneously abundant and uncertain. This does not mean it replaces currency, but it does begin to function as a parallel signal of confidence in the monetary order. When that confidence weakens, silver tends to move ahead of broader commodity indices, not behind them. Implication is straightforward but often missed. Silver is transitioning into a market where its price is determined less by what it is used for and more by what it represents when trust is under pressure. That is a fundamentally different regime from the one most models are built on. Real yields sit at the center of the silver price mechanism in a way that most surface-level analysis consistently misses. Nominal interest rates dominate headlines, but they are not the true driver of precious metals. The decisive variable is the inflation-adjusted return on holding sovereign debt. When that return is positive and stable, capital has little reason to move into non-yielding assets. When it turns negative or unstable, the entire allocation structure of global portfolios begins to shift. The reason silver is so sensitive to this dynamic is that it occupies a hybrid position between industrial commodity and monetary asset. That duality makes it more reactive than gold when financial conditions change at the margin. Gold responds primarily to long-term monetary confidence. Silver responds both monetary confidence and liquidity conditions in the short run. Real yields sit precisely at that intersection, acting as a transmission mechanism between central bank policy and physical asset pricing. When real yields rise in a credible and sustained way, it signals that policy rates are ahead of inflation expectations. In that environment, capital is rewarded for staying within the sovereign debt system. The opportunity cost of holding silver increases not because silver loses intrinsic utility, but because the relative attractiveness of safe interest-bearing assets improves. This is when silver tends to underperform or remain range-bound, even if industrial demand is expanding steadily. However, the more important regime shift occurs when real yields begin to decline or oscillate unpredictably. This does not require dramatic nominal rate cuts. It can occur even when central banks maintain a restrictive stance if inflation expectations remain persistent or a fiscal dominance begins to influence monetary credibility. In such conditions, the market starts to discount the real return on sovereign assets rather than the nominal return. That subtle shift is where silver begins to reprice. The mechanism is psychological as well as mechanical. Institutional investors do not move in binary fashion. They adjust marginal allocations based on changing confidence in future purchasing power. When real yields compress even modestly, it signals that the monetary system is no longer delivering predictable compensation for holding currency-denominated instruments. At that point, assets outside the system, hard assets with no counterparty exposure, begin to absorb incremental flows. Silver benefits disproportionately because of its smaller market depth relative to gold. There's also a reflexive component to this process. As real yields fall, gold typically leads the initial move. Silver lags in the early phase because it is still anchored by industrial assumption, but once the move in gold is established and sustained, capital begins to search for higher beta expressions of the same macro theme. Silver becomes that expression. The delay creates compression, and compression leads to expansion once thresholds are crossed. What complicates the analysis is that real yields are not directly observable in real time with precision. They're derived from inflation expectations, which themselves are subject to revision lag and sentiment distortion. This creates periods where the signal is obscured. Markets often misinterpret these phases as stability when they're actually transitional. During these transitions, silver can appear disconnected from fundamentals, oscillating without clear direction. In reality, it is accumulating pressure based on delayed monetary signal. Another structural factor is the asymmetry between policy intent and market interpretation. Central banks may signal tightness, but if fiscal expansion offsets monetary restriction, real yields can drift lower even in an anomalously restrictive environment. The market responds to the combined effect, not the stated policy stance. Silver, being highly sensitive to liquidity perception, reacts to this combined signal faster than most macro assets. Once real yields cross into persistently negative territory, the behavior regime changes entirely. Holding cash or bonds becomes a guaranteed erosion of purchasing power. At that point, the distinction between investment and preservation blurs. Silver begins to attract not just speculative flows, but defensive allocation. This is a critical distinction. Speculative flows are volatile and short-lived. Defensive flows are slower, but more persistent, and they tend to sustain higher price floors over time. The most important implication is that silver does not require extreme macro conditions to move. It requires a marginal shift in real yield expectations. Small changes in perceived real returns can trigger disproportionately large reallocations because the market is constantly balancing between liquidity, safety, and purchasing power protection. Silver sits at the intersection of that tension, and real yields are the lever that tilts it one way or the other. In that sense, real yields are not just an input into silver pricing, they're the trigger mechanism that determines when dormant monetary demand becomes active. Silver miners are often misunderstood as simple extensions of the silver price, but in reality, they function as a leveraged expression of multiple macro forces operating simultaneously. They are not just operating businesses tied to a commodity input. They are financial amplifiers of shifts in liquidity, credit conditions, and marginal pricing power in the metals complex. When silver begins to reprice under monetary pressure, miners do not move in linear fashion, they move in convex fashion, where small changes in the underlying metal can translate into disproportionately large changes in equity valuation. The first layer of leverage comes from the structure of their cost base. Unlike physical silver, which is priced directly in global markets, mining companies operate with relatively fixed production costs in local currencies while selling output in US dollars. This creates a natural operating leverage to changes in price. When silver rises, revenue expands immediately while costs adjust more slowly. This compression of costs relative to revenue leads to margin expansion that can outpace the underlying commodity move. However, the more important layer is financial leverage embedded in their capital structures. Many silver miners carry legacy debt, long-term development obligations, and capital-intensive production schedules. In stable or declining silver environments, these obligations act as a drag on equity performance. But when silver enters a sustained upward trend, cash flows expand quickly, balance sheets improve, and refinancing risk decline. This shift in perceived credit risk is often underappreciated by markets until it is already in motion. There is also a behavioral component that intensifies this leverage. Equity markets tend to price mining companies not on current production alone, but on discounted expectations of future cash flow under assumed price scenarios. When silver begins to move due to macro drivers such as declining real yields or currency debasement concerns, analysts revise long-term price assumptions upward. This does not just affect one-year earnings, it reshapes entire valuation frameworks. The result is multiple expansion layered on top of earnings expansion. This dual mechanism, earnings leverage plus multiple expansion, is what creates the asymmetric profile of silver miners. In early phases of a silver rally, miners often lag the metal itself because investors are still skeptical about sustainability. But once confidence in the underlying macro driver strengthens, capital rotates aggressively into equities to capture amplified exposure. At that point, miners can now outperform silver by a wide margin, not because they are stronger businesses, but because they are a more sensitive instrument. Another critical factor is cost curve positioning. The silver mining industry is not homogeneous. A small subset of producers operate at low marginal cost, while the larger group sits much closer to break-even levels. When silver prices rise above the cost of higher-cost producers, those assets suddenly transition from marginally viable to highly profitable. This shifts the entire industry perception from survival mode to expansion mode. Markets then begin to price in production growth, reserve revaluation, and exploration upside simultaneously. Supply constraints further intensify this dynamic. Unlike financial assets, mining output cannot be increased rapidly in response to price signal. Permitting delays, capital expenditure requirements, and geological limitations all create a lag between price incentives and production response. This lag ensures that when silver moves, miners experience a period of margin expansion before supply catches up. During this window, equity markets tend to re-rate aggressively. It is also important to recognize the reflexive loop between silver and mining equities. Rising miner valuations can reinforce bullish sentiment in the underlying metal by signaling structural tightness and profitability across the sector. Conversely, weakness in miners can suppress speculative interest in silver even when macro conditions are supportive. This bidirectional influence means miners are not just passive recipients of price changes, they are active participants in shaping sentiment. Liquidity conditions play a decisive role in this entire structure. Silver miners are highly sensitive to shifts in risk appetite because they sit at the intersection of commodity exposure and equity beta. When liquidity is abundant and real yields are declining, capital flows toward higher volatility assets in search of return amplification. Miners benefit disproportionately in this environment. When liquidity tightens, the same leverage works in reverse, producing sharp downside adjustment. What distinguishes silver miners from other commodity equities is the degree of convexity embedded in their exposure. They are not simply tracking silver, they're magnifying its macro signal. In environments where monetary conditions are shifting, particularly where real yields are compressing or currency confidence is weakening, this convexity becomes the dominant feature of their price behavior. The end result is that silver miners function less like traditional industrial equities and more like leveraged macro instruments. Their valuation is not anchored solely in production metrics, but in the evolving perception of monetary stability, liquidity direction, and real return expectations across the global financial system. The most persistent blind spot in the silver market is the assumption that supply will respond in a timely and elastic way to price signals. That assumption may hold in theoretical commodity models, but it does not hold in the real structure of modern mining economics. What is unfolding today is a slow recognition that supply constraints are not just temporary distortions in the cycle, they are structural features that have been systematically underestimated for years. Silver production is not driven primarily by dedicated silver mines. A large portion comes as a byproduct of copper, lead, zinc, and gold extraction. This matters because it means silver supply is not independent responsive to silver price alone. Even if silver prices rise sharply, the production decisions are often governed by the economics of base metal. If copper or zinc economics are weak, mines do not expand output simply because silver is attractive. This structural dependency creates a bottleneck that cannot be solved through price discovery alone. At the same time, the industry has been operating under a prolonged underinvestment cycle. For more than a decade, capital allocation in mining has been constrained by shareholder pressure, environmental regulation, permitting delays, and capital discipline frameworks imposed after earlier boom-bust cycles. The result has been a chronic underdevelopment of new projects, exploration budgets were reduced, marginal deposits were abandoned, and expansion projects were deferred. These decisions may have been rational in the low-price environment, but they created a delayed supply response that is now becoming visible. The problem is that mine supply does not operate on quarterly cycles, it operates on multi-year, often decade-long timelines. Even when capital is deployed today, new production does not come online quickly enough to respond to current price signals. Permitting alone can take years, followed by construction, infrastructure development, and ramp-up phases. This introduces a structural lag that prevents supply from equilibrating efficiently with demand shocks. What makes the current environment more complex is that demand is not purely industrial. The traditional framework assumes that silver demand rises and falls with manufacturing cycles, particularly in electronics and solar energy. While these components remain important, they are no longer the dominant driver. Investment demand, monetary hedging behavior, and portfolio real estate dynamics now play a significantly larger role. These forms of demand are faster moving and less predictable than industrial consumption. Supply, however, remains slow moving and rigid. This mismatch between flexible demand and inflexible supply creates periodic dislocations. In earlier phases, these dislocations were absorbed by inventories and above-ground stockpiles, but those buffers are no longer as robust as they once were. Years of structural deficits in physical silver markets have gradually reduced available slack in the system. As inventories tighten, the market loses its ability to smooth price shocks through stock releases. At that point, pricing becomes more sensitive to marginal changes in flow rather than total stock. Another underappreciated factor is declining ore grades. Even where production remains steady, the quality of ore being extracted is deteriorated over time. Lower grade ore requires more energy, more processing, and higher input costs to produce the same amount of metal. This means that maintaining current production levels requires increasing capital and operational intensity. In snorts and clears throat, that dynamic erodes the responsiveness of supply to price incentives. Energy costs further complicate the picture. Mining is an energy-intensive industry, and energy inputs have become more volatile and structurally elevated in many regions. This introduces another layer of cost rigidity that limits the ability of producers to scale output efficiently even when silver prices rise. The margin expansion required to justify new production is partially absorbed by rising input costs elsewhere in the system. The market's mispricing comes from extrapolating past behavior into a structurally different environment. In previous cycles, rising silver prices eventually triggered meaningful supply responses that helped cap rallies. That feedback mechanism is still assumed to exist in pricing models, but the underlying conditions that supported that mechanism, readily available capital, high-quality undeveloped deposits, faster permitting, and stronger exploration pipelines have all weakened simultaneously. As a result, the system is now operating with reduced elasticity. When demand shifts upward, supply does not respond in a smooth curve. It responds with delay, friction, and in some cases not at all within relevant investment timeframes. That creates a different kind of price behavior, one where adjustments occur through price spikes rather than gradual rebalancing. The critical implication is that the market is still pricing silver as if supply will eventually normalize in a timely fashion. But normalization, even if it occurs, may arrive too late to influence the current cycle dynamics. In the meantime, the imbalance between constrained supply and shifting demand continues to widen beneath the surface. What matters in the second quarter is not simply direction, but timing within the global liquidity cycle. Markets often assume that valuation changes are gradual and anchored to fundamentals. But in reality, major repricing events tend to occur during narrow windows when liquidity conditions shift at the margin. Silver is particularly sensitive to these windows because of its relatively small market size, dual demand structure, and high beta exposure to macro liquidity flows. Liquidity is not just the presence of capital, it is the willingness of capital to move across asset classes without friction. When liquidity is abundant, risk premium compress across the system. When liquidity tightens even slightly, risk premium expand quickly and unevenly. Silver sits near the high end of that sensitivity spectrum. It is not a core reserve asset like sovereign bonds, nor is it a purely industrial input like copper. It occupies a transitional space where both investment flows and industrial demand compete for pricing dominance. That makes it highly reactive when liquidity conditions change. The second quarter often becomes a focal point in liquidity analysis because it sits between fiscal policy recalibration periods and central bank forward guidance cycles. At this stage of the year, markets begin to reassess rate trajectories, inflation persistence, and refinancing conditions for both sovereign and corporate debt. These reassessments are rarely smooth. They tend to cluster around new data releases, policy signals, and funding market stress points. When these clusters occur, liquidity does not just shift, it reprices across entire asset categories. Silver responds to these shifts disproportionately because its market depth is limited compared to gold or major equity indices. A relatively modest rotation of capital out of fixed income or cash equivalent instruments can produce outsized price movement in silver simply because the absorption capacity of the market is smaller. This is the essence of a repricing window, not a change in long-term fundamentals, but a temporary imbalance between available liquidity and available supply of exposure. Another critical factor is positioning. Entering the second quarter, market participants often carry residual positioning from the first quarter based on earlier macro assumption. These positions may be built around expectations of persistent rate stability or controlled inflation trajectories. When those assumptions begin to shift even marginally, positioning adjustments can become forced rather than discretionary. Forced position adjustments tend to accelerate price movement because they remove patience from the decision-making process. In silver, this dynamic is amplified by the behavior of leverage instruments and derivative exposure. Futures markets, option structures, and mining equity leverage all respond quickly to volatility and underlying price expectations. When liquidity conditions tighten or shift direction, margin sensitivity increases. This can create cascading adjustments where initial price movement triggers further liquidation or reallocation, reinforcing the move. It is also important to recognize that liquidity-driven does not require crisis conditions. It can occur in relatively stable environments where only expectations change. A modest shift in real interest rate expectations, a change in central bank balance sheet language, or subtle deterioration in fiscal credibility can be sufficient to alter liquidity preferences. The key variable is not severity, but directionality and surprise. Markets price in expected conditions.